Good afternoon, everybody, and welcome to the latest in our series of professional advisors working lunches, today brought to you courtesy of our partner, Baillie Gifford. I'm Hope Williams-Smith, editor of Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me quickly run you through the usual housekeeping. Your microphones and cameras are currently switched off, and we'd be most grateful if you could please keep them that way, just to ensure there's no background noise and so our speakers can be heard nice and clearly. I should also inform you that this session is being recorded and we will send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. As usual, today's working lunch will qualify for 1 hour of CPD and we'll be sending your proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. Now, I think it's fair to say that the last 18 months have not been kind to the holders of US growth stocks. Among those who have felt the pain of the US growth correction are Baillie Gifford. So today I am delighted to be joined by Fraser Thomson, who is Client Service Director with Baillie Gifford American Fund. Over the next hour with Fraser, we'll examine what drives corporate growth and consider why stock markets tend to underappreciate the value of businesses with the most appealing growth opportunities. We'll discuss Baillie Gifford's perspective on the prospects for growth in a more challenging economic environment, and Fraser will outline their views on where the next decade's brightest return opportunities in US equities might lie. Do feel free to put any and all of your questions to Fraser using the chat function, which you will find in the bottom right-hand corner of your screen. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message so that only I can see it. So just before I hand over to Fraser, let me quickly run you through our learning objectives for today. So by the end of this session, you will be able to explain the structure of the stock market returns and their relationship with corporate fundamentals, understand the definition and explanation of expansion, disruption, and replacement as drivers of corporate growth, and understand exploration of the information technology revolution. So that is the CPD covered, and I'll now hand over to Baillie Gifford's Fraser Thomson. Good afternoon, Fraser.
Hi, Hope. Thank you very much for the introductions and for hosting us today. And actually, thank you to everybody for giving up an hour of your lunch for today's session. I really hope you find this useful. I'm looking forward to taking your questions as we go through this hour, so please don't hold back. As Hope said, holders of the American Fund, which is primarily what we're basing today's discussion on, holders of that fund will know that we've been through a really pronounced performance cycle over the past 2 or 3 years. And that recent returns in particular have not been easy. So we appreciate that will have been challenging for you and your clients, and we absolutely do not take that lightly. As I hope you'd expect, we have been through the holdings in the portfolio in a great deal of detail, and we have reflected deeply on our own process as well over the past couple of years. There are certainly some lessons to take from that. What we have not done is change our investment philosophy stripes, and we're not going to. And section 1 of today's discussion will walk through what we see as the key elements of the structure of stock market returns and why we think those are such a constant. And hopefully that will give you some insight into why we remain positioned the way we are. We'll then go through some of those lessons that we've taken from the recent past, in particular the drivers of corporate growth as we see them for the next several years ahead. That will form the basis of section 2. And then, as Hope mentioned, we will finish up with a case study of one of those in particular, so the information technology revolution and how we think that might influence returns for the next decade. And in doing so, I hope we give you some kind of insight into why we've continued to own the companies that we do and where we're looking for new opportunities. Because opportunity and optimism are really important here. And I think at times it's felt like optimism is in really short supply, which potentially might make it particularly valuable at this juncture. So getting straight into it, so the structure of stock market returns. Well, what do we mean by this? Well, we mean the way that stock market returns are distributed. They are not normally distributed, so they don't cluster around an average for any individual company, and then with a few doing a little bit worse, a few doing a little bit better on either side of that middle ground. That is not the structure for share price returns. The downside is capped to the amount of money you invest in a stock, so 100%. There is no theoretical cap to the upside to owning a successful individual stock. So that potentially drives a very different return profile. The implications of this are actually quite profound. If we look at a very long time series for stock market returns in the US, so taking 90 years going from 2016 backwards, based on the work of Hendrik Bessenbinder out of Arizona State University, we can see there are around about 25,000 companies in that population. And they have generated tremendous excess wealth over and above a United States Treasury bill over that time frame, so $35 billion of excess wealth. But actually, the best 1,000 of that population are responsible for all of that net wealth creation over and above the risk-free rate. Everything else just nets out to the return from a T-bill. And even within that 1,000 companies, only 90 are responsible for around about half of the net wealth generated by US stocks. And this is really a kind of astonishing result. It tells us that stock market returns are very concentrated, and that skewed return profile means that the most successful companies exhibit a disproportionate influence on the overall return available from stocks at large. Now, of course, we realize that 90 years is not a particularly practical time horizon to invest over. It's not the time horizon we invest over, but this same pattern holds true when you look at rolling 5-year returns of stock markets, which is, I think, a much more sensible time frame to consider. And we can look at this in a little bit more detail as I share my screen here. So this is the profile of stock market returns over rolling 5-year periods in the S&P 500. So it's that same story, a tale of outstanding investments to the right-hand side of this chart drives the overall return profile. We set our bar at the top 20% of those companies. So the best 20% of the S&P by population will deliver 2.5 times or better over any given 5-year period on average. So again, multiples of their starting share price. Patience is a really important ingredient here. So this is a persistent feature of stock markets, but it's one that's not as widely understood or appreciated as you might think. Unlike you or I, the typical investor on the New York Stock Exchange holds a company for under a year. I think it's 8 or 9 months on average. So that is not enough time for this return profile to be meaningful, or for the attractions that drive that return profile to show themselves in most cases for any given company. By contrast, we research companies on a 5 to 10 year view, so we're aiming at the right time horizon, and we hold companies for a similar length of time as well. So we give them time to deliver on their superior characteristics in their pursuit of outlier type returns, because we know that's what drives the overall return for portfolios.
Fraser, I was just going to come in here and ask, practically speaking, does researching a company on a 5-year view, what does that actually look like for you?
Yeah, I think it's important to set our stall out here. So I think it's underpinned by quite a specific culture at Baillie Gifford. Others may do this different ways. But fundamentally, what we're looking for are individually unlikely but rewarding outcomes over a long time frame. And if you're going to embrace that kind of uncertainty in the way you invest, you have to have a culture that supports that. So for us, it starts with our partnership. The owners of the business all work within the business. So there's no external short-term pressure, but it also comes down to the way we recruit, train, and reward our staff. So investors are remunerated on a 5-year performance view. They are rewarded on softer factors like the quality of their investment research and their collaboration with their colleagues. Individuals will place a lot of pressure on themselves anyway in this kind of environment. We need to be able to support risk-taking and long-term investment views. But I think it also comes back to the kind of information that we're looking for. So we don't make much use of financial services research at Baillie Gifford. And that's not because it's not written by smart people. I'm sure it is. It's just simply written on the wrong time horizon for us. It tends to focus on the next quarter or the next year's outcomes for a business. And that doesn't tell us a lot about the 5-year return potential in our view. It's also what everybody else is typically reading, and we don't view ourselves as being smarter than anybody else in terms of analysing data. So we go out looking for a very different data set. And I'll bring my screen back up to show this just quickly. So we place a lot of importance on access to company management. These are the people that are going to drive a business for the next 5 years. The way they are incentivized, their capabilities, their ability to innovate and bring along their staff base with them make a huge difference to the returns on offer for a company. So we spend a lot of time with company management and try to get a layer below that as well. So for example, Gary Robinson, who's a manager of the American fund, he spent a day last year with Moderna, one of our larger holdings in Boston. And he did what you'd expect. He met the CEO and the exec in the boardroom, and he talked to them. But he spent the rest of the day talking to the individual heads of the various vaccine trials underway at Moderna at the time. And that's one, to assess the rate of success, the rate of progress of those individual trials. But secondly, it's also to try to understand how the cultural framework around them either support or take away from their ability to make progress. So Moderna has a tremendous platform technology opportunity, but the way in which it deploys that to its staff will, to a very large degree, dictate how much benefit it's able to make of that. And that's really important to us. So we are on the road constantly. We are aggressively outward looking in our information seeking. So I think, as it happens this week, most of the US team is out on the road in the States. They're going to meet in aggregate 91 companies this week, and they'll come back and discuss those insights at length for the following weeks. As well as that, I'll dot around this page just quite quickly. We also try to make use of academics. They're not going to give us stock ideas, but they are going to help us understand the structural drivers underpinning growth. We use investigative researchers from a kind of journalistic perspective to access research that we would find it difficult to within our own skill set. And we also make use of our private company team, which is expanding at Baillie Gifford. Now, the American Fund is a listed only vehicle, and that will remain the case. But having an insight into that other side of the coin, I think, makes quite a big difference to us. When we operate in such an unstructured way in terms of research gathering, we think it's really important to give people freedom. I think it becomes particularly important that that information is gathered into a very consistent framework. So that makes it consistent and repeatable in terms of achieving this approach. So our research goes into an 8-question framework for the US team every single time. We cover the key investment questions in the same way, albeit the underlying information sources will vary to suit.
Fraser, just a quick question again from me here. How do you put recent outcomes from your strategy into this context? I mean, it's quite fair to say that holders of the American Fund have had quite a torrid time last year amid the big falls in valuation.
Yeah, that's a really fair observation. I think that this is when our process and our philosophy gets tested. We are certainly opening to questioning parts of that, but what we don't want to do is change our stripes under pressure. And you're absolutely right. Come back to the comments at the top of this. It has been a torrid time for holders of the fund. We recognize that. Our investment style means that the fund's value will vary considerably in short time periods, and probably much more than broader stock markets. We are holding 30 to 50 investment ideas at any one time, and it's not uncommon for 50% of the weight of the fund to be in the top 10 holdings. So that's very different to the wider index. And it means that the time horizon of shareholders of the fund matters just as much as ours. So I think holders have to be aware of that and have to be willing to hold through those kind of periods of volatility alongside us, because we are willing to hold through significant steps down in individual company valuations, provided we can see that the fundamental opportunity persists. We know that some of our most rewarding stocks have fallen up towards 80% during our ownership of them, but they've ultimately still come through to deliver really attractive returns to our shareholders. Some of the examples here, Tesla and Moderna, for example, will be well known, but it's actually not all that uncommon a trait for the kind of companies we typically invest in. And when a certain group of them are all affected at the same time by some similar external factor or share price sentiment, you can see that wash through quite quickly to the fund. Now, what we're wary of doing is being shaken out of really good companies through share price volatility. that we know that selling stocks that go on to produce outlier returns is actually the most costly mistake we can make for holders, even though it's one that's typically a little bit hidden from view. And I'll maybe use an analogy here. And analogies are never perfect, but I think this is still worthwhile walking ourselves through. Sometimes selling companies seems like a really credible thing to do. So if we go back to 2008 and the global financial crisis, you can see that the revenue rates of some of the most rapidly growing companies from that time, Amazon, Google, and Apple amongst them, were up at kind of 40% type aggregate levels when you average them out. But as the financial crisis unfolded, their revenue growth rate slowed pretty markedly down towards the kind of single-digit type rate. At the same time, their share prices fell, so peak to trough for Amazon, Apple, Google, it was more than 60% falls for each of them. So while you were sitting there in 2008 or 2009, looking at slowing revenue growth being delivered by these companies, a falling share price, and frankly, the broader backdrop in meltdown, it would have felt very sensible to think, well, should we be taking ourselves away from these kind of opportunities? You know, is this done for these kind of companies? Now, looking back, we can see really clearly that the macro didn't have much to do with their future success. And that was because of the potency of the shift that those companies were driving and benefiting from. And that's what really came through very strongly in the following 10, 15 years. Now, you'd have done very well if you'd bought into those companies at their trough. You still would have outperformed the market by some distance by simply holding those companies throughout that period. And that's a really strong reminder for us that where the fundamentals stack up and where it's a strong structural driver, that companies can work their way through quite considerable share price volatility.
Fraser, is this just a one-off data point? Because, of course, the circumstances are quite different this time.
Well, that's very fair. I mean, obviously, there was tremendous stimulus packages rolled out post-2008, which you could argue had quite a big influence over the stock markets in the following years. But actually, no, this is not a one-off. And we can see a really consistent pattern when we look at stock market returns versus delivered growth. And I think this kind of rounds out the section on the structure of stock market returns. Companies that deliver the best earnings growth on any given 5-year period always outperform the wider stock market. This is true in good economic times or bad economic times. This is true when growth is in favor. It's also true when during these grey periods when value as a style was in favor. Ultimately, companies that are able to sustainably deliver above average earnings growth get that recognized in their share price returns. So this top line indicates relative outperformance over and above the wider market for the top 20% of revenue of earnings growth. The blue line represents the worst earnings growth companies from that population. They always underperform over that same time frame. So ultimately, the fundamental opportunity in front of a company does tend to drive share price if those companies can capture it. Then that's not to say that cycles don't matter. It's not to dismiss the current situation that we are in. All of those things are really important. But the point here is that a combination of structural change driving growth and the long-term perspective has tended to be a very good way to generate returns from stocks over a 5-year plus time frame. And we think these key elements endure.
So as Fraser was saying, that does bring us to the end of the first section of today's discussion. But just quickly, Fraser, before we tie that up, I just wanted to ask what actually drives the growth that delivers share price performance, and has your view of those drivers changed in what is undeniably a much tougher environment?
Yeah, I would kind of call this the $1 trillion question, and it's one that we ask constantly, particularly so over the past 6 to 12 months, because and I think kind of underlying a question, because even though the companies that are in that top 20% of growers always outperform, it's not always the same type of company. So the drivers of growth shift with time. You can see that when you look back over the history of stock markets. We can see that when we look back over the history of our own portfolios. Sometimes there are themes across a whole set of holdings which endure for a period of time, but then they fall away as new drivers become more important. So we are certainly not complacent about this. There is clearly a capacity for change. And when we look at the capacity for change right now, we're seeing an interest rate environment, which is much more challenging. That could endure for periods relevant to our investment time horizon. We are seeing the idea of globalization be really very challenged, and global political lines are being redrawn. I think that's meaningful to us as well, even though we're bottom-up stock pickers. That changes the limits and rules of the game for us. And I think what we need to stop and ask ourselves is what we're going through now a market cycle analogous to 2008, where the drivers endure? And that's something that we can credibly and should look through and invest through. Or is this an indication that there is a different set of drivers emerging because of those different investment conditions? And will something else power corporate growth from this point forward? And in answering this question for ourselves, we try to pull apart how growth happens at the corporate level. And for us, there are three key elements to this. The first is that recognizing that companies operate in systems. So whether that be a marketplace or a local economy or an industry, there is a degree of codependency in a network that these companies operate within. Comes in all shapes and sizes. Sometimes that system is growing and a rising tide will lift all boats. And when that happens, that expansionary driver is in play, then you can see broad-based corporate growth in any given market or industry. And I think people often conflate growth investing with that kind of expansionary driver. And that is right some of the time, but it's not a prerequisite for corporate growth. And for us, actually, a much bigger determinant of growth is typically change, so dynamism within those systems. And this is laid out here. I appreciate this is rudimentary for some of you, but it does kind of underpin the way that we're positioning the portfolio. In the expansion will be there some of the time, but not all of the time. The bigger thing for us are things which affect the demand side of the equation, so societal expectations, customer shifts, things which can disrupt the demand side of the equation. So typically innovation, whether that be technological or business model. And those often are the far more important drivers of growth down at the individual company level. So to kind of bring that to life a little bit through a holding in the portfolio, we take something like a pet owner's demand for dog food. That might be a relative constant, but if that pet owner if pet owners in aggregate start to become fed up with picking that up, that bulky heavy good at a supermarket or pet food retailer and dragging it to their car, or instead start to opt for an online subscription model which delivers that to your door every week or fortnight and in a way that adjusts to your pet's health profile and age, then all of a sudden we can see that there's appetite on the demand side for a different offering, and that supply is coming on stream to cater to that. And the really interesting thing for us is that often that new supply comes via a new entrant to that market, as opposed to the existing incumbents who find it hard to disrupt their own existing business model. And I think this point around growth and dynamism becomes really, really quite important to us. And when we try to look at what drives dynamism and change in industries, we still keep coming back to Peter Drucker's 7 sources of innovation. Now, this dates way back to 1985 and his book, Innovation and Entrepreneurship. But it has survived the test of time. We still can't find a better rule of thumb than this one. And he sets out 7 key sources of innovation that open up the opportunity for corporate growth and entrepreneurs. And when we look through these, we find that we can make a strong case for all 7 of these right here, right now. And that has not always been the case when we look back over the history of the American fund. Picking out a couple of examples, that's something like a demographic shift. Well, that's a relative constant, that's often in play. But when we take something like that and apply it to social media, the 18 to 24-year-olds of now probably wouldn't be seen dead on Facebook, but they are moving to other forms of social media like Snap and TikTok, and they are interacting in new ways online through kind of communities and platforms like Roblox, which is an immersive user content generated gaming environment. And those are things which are really interesting to us, because that is a population that has grown up with the internet as an ever-present in the background. It's not new to them, it's just how life is. And if they move more and more of their leisure and spending habits into that world, then some of these platforms could be tremendously powerful over the next several years. Or if we take something like the zeitgeist shift, for example, the move from win-at-all-cost capitalism to a broader stakeholder capitalism. We hold a company called Lemonade in the portfolio. It's an insurance business. Insurance is not known for being a disruptive or fast-moving sector. But Lemonade says to its customers, well, if we make more profit than we expect from your policies on average, we'll send that excess profit back to charities of your choosing. And I think that completely changes the relationship with insurance companies. It typically has a very low trust between both the customer and the insurer, but that changes that. That reduces the incentives for people to overstate their claims. It changes the way that companies are likely to behave in processing them. And it's taken a new entrant like Lemonade, unencumbered by its book of legacy business, to come in and offer that quite different model. So I think when we look through this, we see a really quite exciting rate of change across the board.
Fraser, does one of these stand out to you as being more important than the others?
Yeah, I think it does. I mean, to an extent, they are all interlinked. It's rare that these exist completely independently, but there is one, and it's the first one. It's industry structure. So shifts in the foundation of industry don't happen all that often, but when they do, they tend to affect everything that's built on top of them, and that's a really big deal for a growth investor on a 5 to 10 year view. And we believe that this is happening right now via the internet and the cloud. So the internet as the infrastructure upon which commerce, media, information flows, and the cloud as the infrastructure upon which IT is stored, organized, and distributed. And we think this is a massive changeover. Effectively, as we'll come on to shortly, this is effectively an industrial revolution that we are living through right now.
Just to play devil's advocate for a minute here as we head into section 3, it would be fair to say, wouldn't it, the internet and the cloud are sort of really well understood by now. So as you move into your next section, could you maybe start off by explaining why you think these are still relevant drivers for the next decade or so of growth?
Yeah, I think that's a fair point. Actually, as I realized as I was saying it, mentioning that the 18-24-year-olds have grown up with this as a constant, kind of actually it tells that picture. This has been with us for 20 years plus. And that's a very fair challenge. Mark Andreessen's famous venture capitalist, his phrase, software is eating the world, that's more than 20 years old now. So I think it's fair to say, aren't we here already? Like, why isn't this done? And at times, given the prominence of the likes of Amazon and so on in our own daily lives, it can feel a little bit like that. But we see this very differently. We think we are possibly at the end of the first innings of the information technology revolution, but about to enter a much broader deployment of this technology across all facets of society, industry, the economy. This is not a view that we have come to completely originally, though. And again, this kind of goes back to this idea that we aggressively seek ideas from outside of these four walls, because we know that's where the vast majority of investment insight lies, and we want to benefit from that. It really comes from work done by a British Venezuelan economist called Carlota Perez, who's pictured on this page. So she has looked at every industrial revolution since Arkwright's mill in the 1700s. She thinks there have been 4 of them since that. So Arkwright's mill being the first, the age then of steam and railways as the second in the early 1800s, followed by steel and electricity in the late part of that century, and then the fourth being oil and mass manufacturing into the 1900s. And it's her contention, and we agree, that we're in the fifth one right now, underpinned by information technology. And the interesting thing for us from her work is that she notes several common traits across all of these industrial revolutions. So at a base level, they all take a really long time to play out, which kind of answers the first part of your question on why aren't we done already. Typically, they take 50 or 60 years to fully embed themselves into society. And it happens, interestingly, in two quite distinct parts. And this is consistent. So in the first part of an industrial revolution, it tends to be that a small number of companies, often the discoverers or inventors of this new technology, rise up rapidly to dominate the sector that they operate in. They generate tremendous growth. They tend to attract in other adjacent industries towards their sphere of influence, and they quickly become monopolistic type entities. This can take 20, 30 years, so I guess quickly is a relative term. But as they do that, you tend to see stock markets become more and more concentrated into those small number of have versus the have-not ideas. You often see a rising level of inequality and actually falling employment. It can be a period of social unrest as well as you get towards the latter part of that installation phase. And obviously, there's not a regulatory framework around those companies because they are doing something brand new. And that can feed into that sort of feeling of turbulence. But what happens over the sort of second half of an industrial revolution is that the technology starts to be picked up by new entities very far away from the starting point. They learn how to apply that in their own context to a different industry. And you start to see a period of much higher than average business creation and higher than average growth. And in that second period, you're kind of seeing all society being moved on to a new and higher plane of productivity. This is when all the wider benefits are actually delivered. You tend to see rising employment, you tend to see falling inequality, and the emergence of a regulatory framework which supports, the sustainable existence of this new technology. And you will often see those monopolists either broken up or their stranglehold reduced on the areas in which they operate. And eventually we'll stop thinking about this as technology altogether, and it will just be fully embedded into society in the same way that electricity is not a competitive edge just now, but the adoption of electricity was a serious competitive edge not much more than 100 years ago. And we think we're going through that beginning of that second part of the revolution right now. So it feels turbulent, it feels really uncomfortable, but actually what we're seeing are businesses pop up really all across our investment universe, often using the internet or the cloud as their competitive edge over an incumbent set of participants. And this gets really exciting when we see previously undisruptable parts of the market be affected by these dynamics. And I think this is something which may only accelerate for the next several years, and which, despite us feeling like we have a really good grip on the internet and the cloud, this is something which is still materially underappreciated by investors. And that's really exciting for us.
So bearing all of that in mind, could you tie that back to the overall positioning of the American fund for us and perhaps give a few examples for our listeners?
Yeah, absolutely. Yeah, I'll maybe jump onto this. Kind of shows the American fund at the year end, kind of by broad thematic collection. Now, all of these are held on their own individual attractions, but when we take a look in the rearview mirror, we can see that there are some themes clearly expressed in the companies we've chosen to own in the fund. And this does tie back to the work of Carter Perez and our ongoing enthusiasm for the capacity for disruptive growth from this point forward. So we still have a really big exposure to the future of commerce. This has been painful for holders of the fund for the past year or so. And in terms of lessons learned, we underestimated the pullback to how things were done before the pandemic. We felt that habits had been broken and that we were on a new and accelerated path to adoption in online retail. And that so far has not proved to be the case. So this has been a difficult period for that part of the portfolio, especially layered on top, the lack of an expansionary driver at this point in time for that part of the portfolio. It doesn't take away the structural enthusiasm we have for this area. We think that the high street is going to be reimagined online, that there will be many players, both general and specialist here, and there's still a tremendous opportunity to own some really rewarding companies in that space. But undeniably, that's been a difficult part of the portfolio for us. We're really enthusiastic about the capacity for business to rebuild itself at the enterprise level, online and in the cloud. When you think about it, actually, a lot of what's happened so far in the IT revolution has been a personal one. We as consumers have moved much more quickly than corporations typically have. Our switching costs are really low. Our ability to experiment is really high. And typically the kind of free to use model has meant that we've been able to pick up and drop things relatively easily online. And our expectations have shifted that there will typically be an app for all manner of potential issues that we face day to day. Those same threads are starting to emerge in the business sphere. This is being unlocked by many of those same business model innovations being brought to bear a more commercial level. So the free to use to experiment type model, the ability to only pay for what you actually consume, the advent of subscription-based selling models has been a big unlock here, and that continues to be the case. That's allowing companies of all sorts of sizes to experiment for little capital outlay with a whole host of online and cloud-enabled services. And that's an area that I would expect us to continue to find ideas in. And then the third, probably more conventional area that we have a really big exposure to is in healthcare, where the continued falling cost and rising speed of gene sequencing is helping to build a deeper and deeper understanding of the importance of our genetic makeup and the genetic makeup of disease in sourcing treatments. That's colliding with this rising ability to process data at a very big scale. And that's exciting. And for us, that opens up the possibility of a genuine paradigm shift in healthcare. So from treating us to when we display symptoms of being sick, to instead a much more continuous and early intervention system that actually aims to keep us healthy. And that could totally upend the cost structure in healthcare and will probably be driven by a whole set of new providers. And we're very much hope that we own some of them already. We are continuing to search for companies in the public space that provide that kind of solution. But then I think, given the backdrop and the way we've talked through Perez and the expanding nature of the IT revolution, I think it's fair to expect that we will find companies across a broader range of end markets in this portfolio. So I would hope that some of these smaller bubbles start to grow and that new ones appear over the next few years. Finance has been a very slow-moving area. We're seeing the early seeds of disruption there, primarily on the consumer side, but structurally there are opportunities to change that. Tesla has driven a transportation revolution up to a point, but actually there's much more to come here, and there'll be more than one really important player in that market. I would expect that to grow. The likes of education, of industrial manufacturing, of the root production of energy. These are all areas which I think are very much up for grabs in terms of disruptive growth, both on that demand side of the equation as society starts to demand slightly different things from companies, but also on that supply side as we see IT in different contexts drive new entrants and disruptive innovation. So I hope none of that discounts what we're sitting in front of right now, but it does also, I hope, explain why the portfolio is still very much positioned the way it was pre-pandemic, and why we're so excited about the breadth of opportunity from this point forward.
Thanks very much, Fraser. We have a little bit of time now for some Q&A. So if you have anything that you want to ask Fraser, now is the time to write that in the question box at the bottom right-hand corner of your screen so that I can ask that. So, Fraser, just to kick us off, I'm interested to hear what you think the biggest challenge for the fund will be in the next 12 months, but then also the biggest challenge in the next 3 years.
Yeah. Gosh, they could be the same thing. So I think the biggest challenge facing our existing holdings is making an adjustment from a growth at all costs type environment when it was rational to pursue market share growth, as aggressively as you could in a really easy capital environment and low interest rate environment. It's in making a cultural adjustment to growth with cost control. Now, the best of our companies will do that and get better in making that transition to a more efficient form of growth. They'll be able to shift towards profitability faster, and we see some really encouraging signs across the portfolio there. But it is a challenge. The error margins will come in. It will test management teams and existing corporate cultures, and I think that's something that we are very much conscious of. We've always looked at the here and now of the companies we own, but setting that against a less forgiving backdrop, I think, is a challenge, and we're working our way through that. On a longer time frame, sort of 3-year time frame, I think the biggest challenge for us is making sure that we are in front of a broad enough set of ideas for this portfolio. As I mentioned, we think we are at this point where we're going to break away from a relatively small number of companies driving the IT revolution to a faster, much greater than average set of business creation. And that creates challenges for us in terms of making sure that we are thinking widely enough to capture that. There'll be some really unfashionable industries that are actually ready for that kind of disruption, have some really interesting companies within it. And we need to make sure that we are casting the net widely enough and early enough to pick those ideas up for this portfolio, because this is a portfolio of transformational growth, and we know that can come from a whole host of companies. That probably speaks to why most of the teams out this week seeing a really high number of individual opportunities.
Thank you. That's a really comprehensive explanation there. A question that we have here from one of our listeners is, are FANG stocks still a must-have within the portfolio, or are they now too expensive?
So the FANG stocks are not a must-have in the portfolio, and that's because we already don't own all of those companies. So we sold Alphabet a couple of years ago, Facebook a little bit before that. We haven't held Apple for a very long time, and that's been, going back to that comment on selling companies that go on to produce outlier returns, that's been a really big mistake for us, and we would hold our hands up to that. That's a missed opportunity over the past decade for us. We haven't held that for a long time. Some of those companies we do own the portfolio. We own Amazon, we own Netflix. I think there's still a really attractive return profile available for some of those companies on a 5 to 10 year view. I think some of them will be challenged, partly because they're so big now, and the law of big numbers means that you've got to really go some to generate big enough opportunities to continue the rate of growth that we ask of our companies. But then also because there is a regulatory framework growing up, growth by acquisition for these companies is probably off the table. There may be more attractive opportunities further down the cap spectrum and into kind of newer territory for us. So I think it's a case-by-case basis, but I hope it's come through that we think we're possibly moving away from the kind of first-generation internet superhero into a slightly different environment over the coming 5 years.
Now, probably unsurprisingly, we've got a question here that says, can you comment on the investment trust and the circa 35% in private company investments? They've said the market is pricing in a lot of risk in private equity. Is it right or is it overdone?
I mean, it's hard to comment on an aggregate basis. I mean, I'd say it for the US Growth Trust. We want the Latitude to hold a sizable proportion of that trust in private companies. We think there's some great opportunities there, and given the level of capital that's previously been available, and actually still available to the best companies, some of those businesses can grow to a really quite large size before having to tap into public markets. Some of them may never come to public markets. So we think there's a really attractive opportunity set available to us. That's why there's up to 50% allowance in that vehicle to hold private companies. And we're still looking for opportunities there. On the valuation side, I'd say that I think we approach that pretty conservatively. We are very active revaluers of our private holdings. So we've looked at those companies at pretty high frequency over the past few years.
Dinner jackets, even.
Yes, it's what the one I bought in.
Yeah.
Sorry, David. I think. Oh, it's okay. David's back on. We've looked at those companies repeatedly. I think we're marking them really fairly, and there's a lot of upside to be had here. I think the difficult mindset shift among some private companies may be adjusting to a slightly different valuation context. So accepting that a down round is actually not the be all and end all here in a different capital backdrop. And the companies that keep on coming back to market for capital when they need it to maximize their growth opportunity, I think will do very well from this point forward.
That sounds really good. Thank you for that. Answering that fairly tricky question there. Slightly easier one now, I think. How can UK investors and advisors get enthusiastic in the current environment when I think it's fair to say many would say there's barely even a case for growth stocks at the moment?
Yeah, well, I think this herein lies the opportunity, to be honest. Not to be glib about this, but the kind of when pessimism feels like it's the consensus view, that's often when actually something really interesting is being missed in stock markets. So I would say that how do you get enthusiastic about growth? You get selective about growth. That's how to drive enthusiasm here. So if you're looking for broad-based growth because of wide economic strength, that rising tide lifting everything, I think that's challenging. I think we acknowledge that there are some headwinds there and they could endure for long enough to affect the growth profiles of the companies we own. But I think running counter to that is this really strong held view within Baillie Gifford that that change within these systems is the predominant driver of growth on a 5-year view. And that actually when there are cost pressures out there, when people are looking to make savings, when there's a challenging backdrop, this is often when innovation happens. Like the need is greatest and people lower their barriers to changing the way they operate because there are savings to be made or there are productivity gains that they're under pressure to chase. So I think actually that can drive growth. Your great companies can be made in difficult times, and actually typically corporate innovation is how we work our way through more difficult spells. And if you look at what has come to market, at higher valuations, but the quality of companies that have come to market and are still making progress, that looks really exciting to us. The quality of companies that are currently private but working their way towards public markets, that looks exciting to us as well. It's an example that we've touched upon briefly, but healthcare, this is a US fund, but if you look at healthcare systems across the world, they are creaking. Like there are some really clear pressures being brought to bear on them. Part of that is demographic, part of that is funding, but I think it's clear that innovation in those markets could deliver a huge social benefit, and those which are able to offer treatments that are more effective first time, that diagnostics that are able to identify vulnerabilities or illnesses at a much earlier stage. These are potential huge cost savers for healthcare systems. They also deliver much, much better outcomes to patients. And so companies that offer that kind of solution, we think will grow rapidly. And we think they're operating in a market where the incentives for people to experiment are really high just now.
Just as we start to draw things to a close this afternoon, Fraser, to finish us off, I'd like to hear your best pitch for US versus everything that we said today. I mean, a lot of advisors naturally have a strong UK bias in their portfolios. So what's the one key takeaway message that you would give to all of our listeners today about why they should be looking to the US as an opportunity if they aren't already?
Yeah. Well, thanks for the opportunity to answer that because it's a bit self-serving, obviously, but I would say that the US is the innovation capital of the world, and that has not changed. That is built upon the American identity, this idea that you can, it's the land of opportunity, be an entrepreneur, make a business out of nothing for yourself. That is culturally sewn into the American psyche, and that's really important. That has empowered a fantastic business environment in the US, supported by a great legal and business support community, really strong academic institutions, and hubs of expertise, not just on the West Coast, but actually across the United States. And when we look at the US as a business creation machine, it's phenomenal to us, both because of that spirit of entrepreneurship, but also then because it has a huge domestic market to grow companies in before they go global. And those ingredients are really hard for anyone else to replicate, and they are likely, in our view, to endure for decades. So I would consider the US to be one of the best, if not the best place to find innovative companies that can grow to scale. And that's certainly what we're looking for.
Fantastic. Well, look, that feels like a really good place to leave things. Thank you, Fraser, for that really fascinating presentation and your look into the fund, and also your insights in our Q&A session. That's very much appreciated. So before we wrap up, let's just take another quick look at our learning objectives from today, which are going to be up on the screen here now. Unfortunately, though, this is all we have time for. So thank you to everybody at home who sent in a question this afternoon for Fraser to answer. And on that note, if you did ask anything else or anything else comes to mind, Fraser and Baillie Gifford will do their best to answer that after the event. Before we close up, I just wanted to assure you again that your CPD will be delivered tomorrow, so keep an eye out in your inbox for that. And finally, let me just leave you with a little teaser of what's to come from Professional Advisor events in what's going to be a very, very busy few weeks ahead for us. Next Tuesday, 14th March, we're running a 1-hour webinar entitled Dealing with Death and Your Future Clients with our good friends over at Quilter. And then for those of you who could do with some help on getting your business prepared for Consumer Duty, we've teamed up with the great people at Sesame Bank Hall Group to provide you with a comprehensive workshop which is designed to take you step by step through the process. Over 3 2-hour sessions across 3 days, we'll take you through the 6 elements of Consumer Duty and provide you with a valuable workbook that's going to help get you there. It is not long now until 31st of July. And we already have over 700 advisors who have signed up for this really important trilogy of events. So do make sure that you book your place today. Closing out the month on PA events will be a working lunch with Schroders. That's on the 29th of March, and that is entitled What Do Advisors Look For in a Solutions Provider? Now for that one, using data from the annual Schroders Advisor Survey, we're going to take a look at the increase in the outsourcing of some or all of the investment proposition. So we'll be looking at what advisors typically look for in a provider and how important are the really key factors: performance, cost, process, service, you name it. Details of all our events and how to register for them can be found on the Professional Advisor website now. And all in all, that is a total of 6.5 hours of CPD for you for the remainder of March. So that's it for today's session. All that remains is for me to thank Fraser once more for his presentation, and our greatest thanks, of course, to you, our readers, for your company this lunchtime. I trust you found this session helpful and worthwhile, and if you did, perhaps we'll see you at another event soon. Goodbye.